If you've ever looked at your bank account at the end of the month and thought, where did it all go? You're not alone. Most people don't have a spending problem, they have a behavior problem. Because here's the truth, financial freedom doesn't begin with numbers, it begins with psychology. The way you think about money determines how you spend it, how you save it, and ultimately, how you grow it. The psychology of spending less and investing more isn't about deprivation, it's about control. It's about flipping the switch from being a consumer to becoming an investor. Because until you master the mental side of money, you'll always find ways to spend more, no matter how much you earn. Let's start with the real reason people overspend: emotional satisfaction. Spending triggers dopamine, the same brain chemical that rewards you for pleasure, achievement, or social validation. Every time you buy something new, your brain gets a tiny hit of excitement. But that excitement fades fast, leading you to chase the next purchase. It's not financial weakness, it's biological conditioning. The system is designed to make you consume. Companies spend billions studying your behavior. They know how to design ads, colors, and price tags that make you act impulsively. That's why the first step toward financial control is awareness. When you realize that every marketing campaign, every limited time sale, and every subscription is designed to make you the product, you begin to see money differently. The goal isn't to stop spending entirely, it's to spend consciously. The wealthy don't avoid spending, they just spend intentionally. Every dollar they spend either buys them time, knowledge, or opportunity. The average person, on the other hand, spends to feel good temporarily. One builds assets, the other buys emotions. Let's talk about the psychological bias of lifestyle inflation. As income rises, spending tends to rise with it. You buy a nicer car, a bigger apartment, more expensive clothes, and before long, you're still living paycheck to paycheck, just at a higher level. The reason is simple: people don't adjust their mindset when their income increases. They assume more income equals more freedom. But freedom doesn't come from what you earn, it comes from what you keep. To escape this trap, you must separate income growth from lifestyle growth. The moment your income increases, resist the urge to inflate your lifestyle. Instead, redirect that increase into investments. Create an invisible system where every time you get paid, a percentage automatically moves into an investment account. You'll never miss what you never see. This single habit is what transforms savers into investors and employees into owners. Here is a psychological framework to help you change behavior. It is called the rule of awareness, automation, and reward. Awareness: track your spending for 30 days without judgment. You're not punishing yourself, you're studying your patterns. Automation: set your financial goals on autopilot. Schedule transfers to savings or brokerage accounts right after each paycheck. Reward: give yourself permission to enjoy a controlled reward after each milestone. The brain needs small wins to reinforce new habits. Once you understand this loop, you can reprogram how your brain relates to money. Now, let's discuss why people struggle to invest consistently. The biggest psychological barrier isn't lack of money, it's fear. Fear of losing money. Fear of not knowing enough, fear of the unknown. But fear is an emotion, not a strategy. The truth is, risk exists everywhere, even in doing nothing. Holding cash during inflation is a guaranteed loss. Investing, on the other hand, is a calculated risk that rewards patience and discipline. Here's the mindset shift you need: stop seeing investing as gambling, and start seeing it as ownership. When you invest, you are not playing the market, you are owning a piece of the world's most productive companies. You are shifting from being a consumer of products to being a shareholder of the companies that produce them. That's how wealth is built quietly, over time. Behavioral finance researchers like Daniel Kahneman and Richard Thaler have shown that people experience the pain of loss twice as strongly as the joy of gain. This is called loss aversion, and it is one of the main reasons investors sell early or stay out of the market altogether. To overcome this, focus on time rather than outcomes. The longer your money stays invested, the lower your risk becomes. In the short term, markets fluctuate. In the long term, they grow. Another key principle is identity-based change. Instead of saying I want to save money, start saying I am the kind of person who invests before spending. Your actions follow your identity. If you identify as an investor, every spending decision becomes a reflection of that identity. That mental shift rewires your habits automatically, because your brain seeks consistency between belief and behavior. One of the most effective strategies to spend less is friction creation. Make spending harder and investing easier. Delete saved payment methods from online stores. Use a 24-hour rule before non-essential purchases. Move your investment app to your home screen and your shopping app to a hidden folder. The easier an action is, the more likely you'll do it, so build friction around spending and flow around investing. Now, let's look at how social pressure fuels overspending. In the age of social media, comparison has become one of the biggest financial traps. You see people flaunting lifestyles they often can't afford, and subconsciously you feel the urge to keep up. But remember, social media shows highlight reels, not balance sheets. Financial peace isn't built on public approval, it's built on private discipline. The richest people you'll ever meet rarely need to prove it. Another important concept is the delay of gratification, the ability to resist a smaller reward today for a larger reward later. Psychologists have proven that people who master this skill tend to achieve higher success in life and finances. Each time you resist an unnecessary purchase, you're not denying yourself pleasure, you're buying future freedom. And that freedom compounds faster than any luxury purchase ever could. Let's go deeper into how you can train your mind to invest more. Start by creating visual feedback loops. Watch your investments grow monthly, even if it's slow. Seeing progress activates the brain's reward system, which encourages consistency. Track your net worth instead of your income. This shifts your focus from earning to owning. And remember, every dollar invested is a silent worker that never sleeps. You don't have to be extreme to be effective. True wealth psychology isn't about cutting everything fun out of your life. It's about aligning your spending with your values. Spend freely on things that make your life better in education, health, meaningful experiences, and cut ruthlessly on things that don't. Here's a quick mental model to remember: spend intentionally, save automatically, invest consistently. This 3-step loop removes emotional decisions from your finances. You no longer rely on motivation, you rely on structure. And structure builds freedom. Finally, let's address the biggest psychological shift of all: seeing money as a tool, not a goal. Money itself has no power, its purpose comes from what it allows you to do. When you master the psychology of money, you stop working for it and start letting it work for you. You stop buying things to impress others and start building things that empower your future. Before we wrap up, remember that your journey toward financial independence starts in your mind. The markets, the strategies, the investments, they all come later. Your financial behavior is 80% psychology and 20% mechanics. If you can master your emotions around money, you can master your finances. And as always, this video is for educational purposes only. It is not financial advice. Always do your own research or speak to a licensed advisor before making investment decisions. If this helped you rethink how you spend and invest, give this video a like, share it with someone who needs to hear it, and subscribe to the channel for more content on building wealth through discipline, strategy, and time, because the moment you stop spending emotionally and start investing intentionally, your path to financial freedom truly begins.